Hi, David Bassanese here, Chief Economist at Betashares. This is a snapshot of my latest market trends report. Just reviewing the month past, we did see a pretty good bounce back in global equities in March. I think principally two key factors here. Firstly, we did see an upsurge in global banking volatility. Obviously, Silicon Valley Bank going under, one of the largest banking failure, I should say, in the US since the global financial crisis. We also saw Credit Suisse come under trouble and be forced to be sold effectively to the other Swiss banking giant in UBS. Now, funnily enough, equity markets have taken that as after initially being somewhat worried about that, they've taken it as a positive sign because it could mean that a tightening of credit conditions by banks themselves, particularly in the United States, could reduce the need for central banks to raise interest rates and so slow economic growth. And so what we did see was that bond yields globally declined, and equity markets after a time took some heart from that, particularly as some of the initial fears with regard to the banking instability started to die down. So all up, we saw a nice rebound in global equities. They're up 2.4% in local currency terms after a decline of 1.9% in February. In Aussie dollar terms, the returns were a little bit higher, around 3.8%, on the back of further weakness in the Aussie dollar through the month. Global bonds, as I mentioned, we did see interest rates fall. As a result, we had a positive return from global bonds up around about 2.1%. And more broadly, what we are seeing is that a peaking of bond yields in late last year has seen bonds start to outperform relative to cash. And equities, broadly speaking, since late last year, have started to outperform bonds on the ongoing hopes on and off of a soft landing in the global economy. We'll wait and see how that pans out. In terms of the Australian market, so another interesting development is the Aussie market did underperform in the month. The total return was actually down 0.2% for the ASX 200. And listed property also had a pretty negative performance, down 6.8% in the month. And broadly, what we're seeing here is the decline in bond yields has favoured the technology, global growth sectors, hasn't favoured financials, obviously. And so given that sector composition, that's tended to hurt the Australian equity market over the month. That's pretty much it from me for now. If you'd like more details on my report, please visit the insights section of our website. Thanks for watching, and I'll see you again next month.